Okay, welcome everyone. We'll start our first lesson. Today lesson will go through LO1, Learning Outcome 1, about understand financing options for different organizations. My name is Anjum Satar and my email address anjum@ukversity.co.uk. So please, if you have any question, drop me email. So let's please. Okay guys, we'll go through. Okay. So before starting our lesson, first of all, we'll check what we supposed to be learn in under this unit. So we have learning outcome 1. Today we'll go through, we have described the main form of financing. We'll go through the merit criteria and distinction criteria as well. We'll discuss. Then lesson 2 will be learning outcome 2 about the working capital, cash flows. Lesson 3 will be prepare the budget and the reports for variance. That's the 3 lessons we'll do, and then we'll go through the 4th lesson about assignment discussion. The aim of this unit is to develop the knowledge and ability in identifying, evaluating the sources of finance, managing, improving the working capital, preparing budget, functional department, understand the importance of budgetary control, small, medium enterprise. That's all will be focused in our lessons. Okay, so guys, let's move back to our lesson slides. Always good to be when we start to reflect, what you know about the sources of finance. What are the major sources of finance? So just spend few minutes and think about which source of finance is better in your situation, in your own organization. Okay, so next. Today lesson will go through the indicative contents, all being given, explain the main features of financing methods, understand the how organization sources of finance different organizations, matching short-term and long-term needs, and Comparision model, which we'll discuss as well. Okay, so first of all, guys, when we'll start any business, you need to be look around what nature of business you are in. Either you're a sole trader type of ownership, or you're a partnership company, or you're a limited liability company. Because the reason your source of finance can be impact. So when you decide a source of finance, always you need to be look around the purpose. Why you borrowing money? What is the purpose of borrowing money? So we need to go through the purpose of sources of finance. Second, you need to look around duration, how long you need it. If you look around the tax implications, okay, look overall cost. So these all the questions you have to ask before deciding the source of finance. Okay, then you borrow the money. Okay, sole trader is a 1% partnership, 2 to up to 20 limited company. We all know separate legal entities, you have a limited liability. So that's other thing we need to be also look around. The not-profit organization, their sources of finance can be different. Yes. Then charities can be registered with the charity commission. The source of finance can be different. So that's we need to be look around different organization types, advantages, disadvantages to start, and what source of finance. So when we look around the sources of finance, which is mean borrowing money, okay, always look around what information you have. Information. So first thing, you get the data. Data you process is become information. If you information you have is become your knowledge, and then you make the decision. Decision making is mean the selecting the best course of action, finding the best option that suits us. Okay, so we have short-term sources can be, even we can use the lease can be short-term, but the long-term, the major source is choosing between the source, risk and the return. It can be equity, it can be debt, hybrid, it can be leasing, venture capital as well. Then the finance for the small, medium enterprise and Islamic financing also is the source of finance. Okay, so when we look the source of finance, select appropriate source of finance. They need to be firm, need to be provide the working capital. Working capital is the running capital. You have to decide how you are investing non-current asset, which is long-term asset, fixed asset. Then of course you can use the long-term borrowing for the long-term purposes, and which will be economics benefit. Asset is mean anything you own it, which will flow the future economics benefit. You can generate money out of it if we work and effectively use our asset. The main source of fund available is return earning, but these likely is sufficient source of finance which meet all the business needs between, and the firm must consider the factor, the cost. Okay, so to find the cost, always good to be look around the base rate. At the moment, you have a basic interest rate 0.01%, so which is quite less at the moment. Yes. So we need to be look around the duration of sources of finance. We need to look around the structure, interest rate. We need to look around the gearing. Yes. So we need to be make sure higher the gear, higher the debt, higher the return. So that's okay. So that's we need to be. So then we need to assess. That's we need to be assess. Okay. So that's all we need to be look around this. Okay. So next slide it demonstrate SMEs, small medium enterprise. Financing issues can be fewer asset, little past history, weak control, funding gap. We have an unmarketable shares, incentive greater elsewhere. So we can look around the potential investor banks. Okay. Business angels is mean the rich people. Yes, like the Richard Bransons and all. These are business angels. Venture capitalists, and then government sources can be, because the funding government is providing as well. So we can look around the improved marketability, specific help available, tax incentive can be available for various some which we can use as a source. So 1.2 is explain how the finance option can be assessed. So you can assess it based on the short term, medium term, long term. Short term we want to be raw material to buy. Short term we want to be look around the raw material. We can look around to buy the games, short term source of finance if I don't have my own money. So yes, but it's in a personal finance I'm just talking about, guys. So we can look around in a business point of view, short term assets. Yes, like we need a computers, we need to be provide the layer facility to our customer. So that's we need to buy that can be used as a short term. Medium term, yes, modern revaluation, advertising that we can borrow money. Long term, normally purchase the non-current asset. Yes, for the long term project purposes we can, and then we can classify. Quantum money required, the large amount of money is not available through the single source. Maybe it's better to be use the mixture of source. Urgency requirement, cost to finance, risk factor, higher the risk, higher the return. So, but we need to be how much risk we can bear it, and then you decide which source of finance will be best for us. And that's the crucial thing we need to be. Then Okay, guys. Next, we need to be look around the recommend the different financing option to be specific organization. So you can choose the example of one organization, and you can look around the what is the can be the factor that's affecting the choice. The amount they required, advice available, loss of control. Yes, if you issuing too many shares to the shareholder, basically you're losing your control as a director, which at the CEO, really you don't want to be the lose the control, because the shareholders are the actually owner of the business and they can kick you out from the business. So that's we need to be. The cost of money, the risk involved. So if you have, you need to be look around debt to equity ratio. What effect will be? So normally, if you think about debt is cheaper than debt, borrowing money, loan through debt is cheaper. Why is it cheaper? Debt is a cheaper than equity. Equity means share. So we said base rate is a 0. So we can get the debt on. We can borrow money through bank maybe 2 to 4 or 5%. Yes, interest rate. But equity holders, the shareholders, they want dividend and they expect around 10% plus. They always looking in at least, double numbers. So that's, the one thing we have to be keep in mind. Another thing, tax implication. When we have a debt, any interest on the debt is the expense, allowable expense for business. We can minus from our profit and loss the expense. But if we are paying dividend, so dividend will be only paid after the tax. So whatever the profit you come after that tax, you have to pay dividend to shareholder. So that's why debt is less costly than the equity financing. So that's, other we have a lot of concept which is called Miller and Malayani, one of the authors, which, I'll go through with you and I'll give you some handouts for as well to read. So that's further, he always said, that is cheaper than equity. So all financial needs of the business can ground into the following categories. So sources of finance, internal, external. Internal mean within a company, whatever the asset we have, we can sell it, we can raise money, we have return earning, that's, the previous year profit, we can use it. That's the internal. External is mean outside the organization. When we borrow, we can go through, and that's, we can. So guys, spend 2 minutes to just think about internal and external sources of finance for your chosen organization. Yes, or within your own organization. Spend 2-3 minutes, please. Okay, so next now we're looking internal source of finance, the various source of finance internally, owner investment, personal source of finance. If you're a sole trader, can be personal or partnership. Few people come together and can finance. Return profit, sale of stock, sale of fixed asset, debt collection. Because we have maybe lot of, the money to collect from our customers, so we can offer them an incentive to pay early, and we can collect the cash from them, and that can be used to finance your owner investment. This comes from the owner own saving. It may be in the form of startup capital used when the business is start, or maybe in the form of additional capital, and this is long-term source. Can be advantages, doesn't have to pay repaid, yes, no interest. Disadvantage can be limited amount, because maybe you don't have enough saving. Yes, a lot of people say, grandparents can be a big source. Yes, if they have a saving, so the kids can borrow the money instead of student loan. So saving another net eggs, so we can look around. Entrepreneurial often invest personal cash balances into the starting up, cheaper source of finance and readily available. So investing personal saving, maximize the control, entrepreneurial keep, these are the advantage. Remortgaging is most popular ways to raising loans. Yes, capital. Entrepreneurial take the second large and larger mortgage, the private properties, and then invest into businesses. That can be other. Okay, borrowing from family friend. They're also common family friends who support and ideas to provide the money either direct to the entrepreneurial into the business, or this can be quicker and the cheaper to arrange certain certainly compared with the standard bank loan and interest, and the repayment term may be more flexible than the bank. However, borrowing is the way can add to the stress faced entrepreneurial. Yes, so that's we need to be think about. Credit cards, yes, sometimes 45 days, 50 days free or credit card that can be used as a source of finance. And that's also is a good source of finance, which we can use to raise the money and that will help. Okay, so next now, return profit. The profit is return profit mean the previous year profit which we retaining, which we can use. It doesn't have to repay, no interest involved, not available for the new businesses a lot. Yes, because of course you don't have a new businesses and business may be enough, the profit to. So that's, maybe don't have it. So that's other problem we have. Sale of assets, yes, we can, but sometimes maybe the business can't be reduce the price of the stock and people not willing to buy. Okay, guys, next we can look around internal sales of fixed asset, the business balances. Let's please spend 2 minutes, read it. Yes, if any question you can ask. So businesses balances sheet usually several fixed asset. Fixed asset is anything that is not used up in the production, the goods and services concerned, land, building, fixture, and so the time one or more these fixed assets may be surplus the requirement and can be sold. Alternatively, business may be desperately need to find some cash and decide to stop offering certain product and services, and the fixed asset can be sold. By selling the fixed asset, business can use them as a source of finance, and selling is the fixed asset, therefore can be affect the potential capacity of the business. So that's other maybe at the moment due to the COVID-19 is a slow turn. We can't offer some product because in the market no demand, but it will pick, when the COVID-19 or the restriction or the lockdown will remove. So that's, we need to be make sure we make the right decision which impact short and the long term positive impact. So that is sometime on money to the business and the business can raise the finance. Yes, that can be, and that's other option, we can look around. Okay, the requirement of the finance various stage as its inception. So when you start your business, so money is needed to be financed with purchase of asset, material, and instrument. People, it also required for day-to-day functioning of the business. So there is a station, the period before the business generate enough cash from the sales so can be to meet the cost. During the expansion phase, the business required invest in technology can be required, that the money is essential start of the business. The development new product can be survival, the fittest. So is the rule the business, therefore constant flow of the new entrance. That's one other thing we need to be look around to improve our cash flow. Okay, guys. So that's we need to follow. Okay, take over our acquisition. Yes, that can be during the expansion stage. It comes necessary for a business to take over our existing businesses and help to expand the customer base, new areas that can be used. Okay, so all these are the option, but always we need to be look around the cost. So fixed asset mean yes can be referred to the capital investment, and that can be purchase of asset like factory building, and these are non-current. Uh, Working capital is mean the running capital, so cash, banks, debtors, bill, receivable, stock. These are all current asset minus current liability is equal to the working capital, and thus we can use as a source of finance. Okay, then next we're looking if you want to be go through the merit criteria, we can look around the long-term finance, source of finance. We can compare and contrast equity and debt financing. As we mentioned, equity mean the shares and the debt mean various of the loan facility through the lender. That's the debt finance. Internal source, external source can be it's a comparison within the company or from outsider. We can look around and we can raise the money to meet our business needs. So owner funds, equity shares, retain profit, borrowed funds, yes, so from the borrowing money. And then we have the when you deal with it, the evaluate Campari model. So you look around the character of the borrower. Yes, look around the ability to borrow and repay. You look around the margin for the bank or do make money out of the loan or not. Purpose of loan, why the money someone is going to be borrowed? Is it just for the entertainment or is it the healthy production will be and the future bank will be sure they will get other lender will be sure. So we need to look at our amount of loan and interest, repayment term, insurance again, non-payment. If somebody don't pay it, what insurance company or insurance is available? We can sell somebody asset, we can pledge it, somebody have asset, so we can look around all these, the things very closely to make the decision. Either we go ahead, we invest it, or we don't invest it, or we'll go through. Okay, that's one we need to. External source can be, of course, bank loan, advantages, set up the repayments, spread, and as earlier I mentioned, the loan is a cheaper source of finance compared to because the base rate is lower. Bank overdraft for the short period of time can be used, yes, and borrowing from the bank, the clearing bank, retail bank, merchant bank, different types of the bank can be used to get the loan. Okay, then the borrowing money, bank will lend you money only if they will be repaid within a reasonable time. Yes. If we don't have a ability to, or we don't, additional partners can be in case of partnership, and we can raise money. But of course, we have to share the profit. Share issuing, the other option, advantages, disadvantages. So we can look around each possible source with advantages, disadvantages, and then we can quantify which one is overall more is a less costly, more duration, more advantages than disadvantages. Of course, finance is all the disadvantages as well. Lease is the short long-term borrowing. Lease can be finance lease and operating lease. Under IFRS 16 International Financial Accounting Standard, on the leases, we need to look around what impact will be on the your statements and the figures. So always, then you can make the decision. Hire purchase like vans and various other things can be used. Hire purchase Mortgage normally long term. Yes, mortgage rate can be very low. Trade creditors we can get. Okay. Then venture capital is a lot of companies. We can pooling the capital into form of limited companies. Venture capital company looking to invest in the opportunity of the fast growing business. Yes, high rated and may also be buy out the firm's administration who's going to be concerned and may also provide the advice, contact, and the experience. And in the UK, venture capitalists have invested 50 billion since 1983. So that's huge area we can look around. And then we've been given, if you want to be read extra, you can copy and paste please these link sources of finance, like especially Kaplan one is quite good as well. Other is good as well, but we can look around the slides. So guys, you can copy and paste these links. So please, before next lesson, it's good to be. I can just show you quick. Yes. So this chapter is all about sources of finance. Is the Kaplan from the Kaplan book and the Kaplan online resources. So that's good to be read before our next lesson. That also help. So you will see here we have a lot of examples there. Sources of finance, what impact on the ratio, lease period, lot of discussion on the shares, the price, the value of the shares, how this impact when we'll issue more shares. Yes, of the old shareholder don't like to be issue more shares because their profit will be distributed in more years the shareholder. Yes. So immediate finance, yes, primary period and secondary period. So all been here, been explained in this, and then we been calculated some numericals and impact of it. So guys, it's quite good to go through, please. That will also help us to be developed. And other is, of course, I mentioned you other link as well, quite good to look around and use. So okay, so what we need to look around this one, I suppose okay. So you can this one as well. If you look here, so that's all the sources of finance, yes, which I mentioned you why and what cost will be, what the CN can be, yes, internal external source and the costing. Yes, is very good example real companies as well. Yes, so please that's also help you to be enhance your concept. Then we have a quiz above, so you can copy and paste it. Please go through this before next lesson. And if you have any question, guys, sources of finance are regarding LO1, so drop me email. I'll get back to you as soon as possible, and I hope so. I'll speak you all during our next lesson next week. Thanks for listening. Thank you. Bye bye.